And here, we reach the endgame, a situation in which the Federal Reserve, having intervened in markets so extensively, has distorted the game dynamics of the system so badly that it now finds itself in a position where it's strategically impossible to exit these markets without adversely affecting them. As a result, the central bank, and indeed central banks all over the world, have become the dominant player in markets, the player upon which all other players now base their strategy, watching every move, every policy change with eagle eyes, trying to spot if Atlas will shrug or not. It's no coincidence that only a year after the GFC, when the real economy was still reeling, markets responded to central bank stimulus by embarking upon the longest bull run in history, a run that only came to an end in 2018, when the Fed, under current Chairman Jerome Powell, did attempt to normalize monetary policy marginally by increasing official interest rates. In response, the market spat the dummy
Dow
and tanked.
stocks are now in the red, and the Dow's gains for the year are gone. A distant memory.
This has led to what's been called the Jay Powell J-turn in early 2019, where the Fed reversed all of the 2018 rate cuts. By this point, it was pretty much game over, because by backing down so completely, the Fed sent a clear signal that not only was it beholden to financial markets and that the Greenspan put was still alive and well, but ultimately that the Federal Reserve as an institution no longer had the capability or political will to normalize monetary policy. In response, the markets rebounded with one of the best single years in history. But in a sign that all was not actually well in the wider economy, the Fed, towards the end of 2019, quietly resumed QE. And that's the problem with such loose monetary policy. Not only does it distort financial markets and cause bubbles unrelated to real financial performance, but it sweeps bigger structural problems under the rug, but can only do this for so long. In fact, many economists were warning pre-COVID that the high levels of debt and the proliferation of zombie companies, and indeed zombie households, pose systematic risk to the economy. So when the black swan event of the global pandemic hit in 2020, all these problems were exposed like rivets popping on the side of the Titanic as it grazed the iceberg. Businesses and households with barely enough savings to stay solvent for 2 weeks, let alone 2 months of lockdown. Massive inequality between the rich and poor, job insecurity and disparity, where most of our underpaid workers, in a sad twist of fate, turn out to be our most essential. In light of the problems it had, a large hand in creating the Fed really had no choice but to appear to ride to the rescue once again, with another astronomical rescue package that saw their balance sheet expand to over $7 trillion, kicking the can further down the road and entrenching itself even deeper into markets. Here's Jerome Powell describing it here.
Fair to say you simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally. And we do that by buying treasury bills or bonds or other government guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve.
Here, the use of the Titanic is an apt metaphor to describe the American economy and the Federal Reserve intervention.
Sea's freezing. Man won't last long in that. We've drawn a bad hand this time.
I've never been a good loser. I intend to get into a boat.
I wish you luck.
Because, like the Titanic, when it sinks, the rich get access to the lifeboats first, and the rest get whatever is left, and, in a lot of cases, are simply left to drown. I'm sure most people would have loved to have been thrown a lifeline of near 0% interest rates on their outstanding credit card debt, business loans, and mortgages. But no, you see, the free market is still in play in the real economy, where risk must still be priced in accordingly and the trickle-down effect of monetary policy is non-existent. Now, we could go into more detail about the extreme nature of this bailout and the fact that a lot of it may in fact be illegal, like the purchasing of lower-grade corporate debt and contracting private investment firm BlackRock to buy junk bond EFTs on its behalf. But we begin this video by suggesting that there was a lot more going on than just the media narrative that stocks were being driven higher by a bunch of stupid retail investors. When viewed through a historical lens, we can see that the real story is actually about the erosion of free markets by central banks via the gross distortion of monetary policy. In this context, the day trader's cry of stocks only go up, you don't fight the Fed, and all the memes about the money printer going brr doesn't seem so stupid after all, but are actually on the money. Even a casual glance at the movement of key indices such as the S&P 500 in relation to the balance sheet bear this out. But if these memes hold true, then it's an indictment on how much of a joke monetary policy and our entire financial system has become. What is even more of a joke is the way in which central bank representatives continue to deny their roles on issues of wealth disparity, inequality, and asset inflation, which brings to mind the great Mark Twain quote, "Sometimes I wonder if the world is being run by smart people who are putting us on or by imbeciles who really mean it." There is an increasing trend to call our present economic period late capitalism, but others have actually likened it to the Fire Festival, which is perhaps more fitting. A world of illusion built on fake money and dodgy credit that glosses over the harsh economic reality faced by people in the real economy. Central bank monetary and regulatory policies have contributed to a form of capitalism where the rewards are going to be 1% and the risks are borne by the 99%. The current crisis response has made it painfully clear again that these policies benefit high-income individuals and large corporations, where small businesses and low-income individuals bear the burden. A little over 30 years since the fall of the Soviet system, we seem to strangely be gravitating towards a new form of it, but of the most egregious kind, a strange hybrid that cherry-picks parts of capitalism when it suits it, and defaults to what amounts to a central planning commission when it doesn't. One in which a small group of unelected officials has made it possible for corporations, banks, and investment funds to take on so much debt with so little of their own capital risk that whenever a recession or financial crisis threatens, we are told that we have no choice but to bail them out, whether it be directly through government and taxation or indirectly through central banks and the erosion of the currency. As a result, profits become privatized while losses are socialized. This is a great departure not only from the vision of a democratic and free enterprise-based system we held up in opposition to the Soviets, but ultimately not the kind of economic system future generations want to inherit.